Shadow banks are the first cracks. You're allowed to see what's breaking right now isn't a bank story, it's a dollar story. And the most dangerous part is that the damage is easiest to hide in the one place almost nobody watches: the shadow plumbing that manufactures liquidity without ever calling itself a bank. Here's the claim. Wall Street cannot afford to say out loud, when the shadow banking layer starts to fracture, you're not watching a local accident. You're watching the first visible crack in the global dollar settlement machine. Roughly, by recent estimates, tens of trillions of dollars of credit-like promises sit outside traditional bank balance sheets, repo chains, prime brokerage leverage, money market conduits, private credit vehicles, derivatives margins, securities lending, total return swaps, and off-balance sheet financing structures that behave like deposits when confidence is high, and behave like explosives when confidence collapses. The number isn't the point, the structure is. Because this isn't a moral drama or a political cycle, it's a mathematical pattern. The same sequence repeats across empires and regimes because the incentives are universal. Build a foundation, stretch it further than it can bear, lose control of the feedback loop, and then watch the system choose a single inevitable outcome. Either an explicit devaluation, a liquidity seizure that forces liquidation, or both in alternating waves. That is the mechanism. It's boring. It's terrifying. And if you understand it, you stop being surprised by headlines. The reason the shadow layer matters is simple. Modern finance runs on collateral and confidence more than cash. The public still imagines a bank as a place where deposits turn into loans. But the real engine is wholesale funding. Short-term borrowing against collateral, or rolling day after day, hour after hour. Repo markets, FX swaps, cross-currency basis trades, securities financing, and derivative margin calls are the arteries. The shadow system isn't an alternative. It is the circulatory system the official system relies on when it wants credit growth without balance sheet constraints. When it's healthy, it manufactures smoothness, cheap leverage, tight spreads, rising asset prices, stable vol. When it's sick, it manufactures suddenness, funding haircuts, collateral scarcity, forced selling, and volatility spikes that appear out of nowhere because the pressure was building in plumbing no one sees. You can feel the outline of the pattern even before you name it. Every cycle begins with a credible foundation, some anchor that convinces everyone the promises are real. That could be gold convertibility, a hard peg, a post-war treaty architecture, a central bank backstop, or simply the perceived inevitability of a dominant currency. Then comes expansion. More claims are issued than the foundation can redeem, but the expansion looks like prosperity. Credit grows faster than output. Leverage becomes innovation. Maturity transformation becomes efficiency. Currency strength becomes confidence, which attracts more flows, which creates more claims. The system gets rewarded for stretching itself. That's the debasement phase. But in modern language, it doesn't sound like debasement. It sounds like liquidity provision, market functioning and risk parity, duration extension, carry, and financial deepening. After that comes the crisis phase, the moment the machine loses control of its own feedback loop. Inflation can surge and force rates up, or deflation can emerge and destroy collateral values. But the common trigger is the same. Funding costs rise relative to cash flows, and the system realizes the promises cannot all be met at once without selling the very assets that back them. That's when the shadow layer reveals itself. Haircuts widen, dealers step back, repo rates gap, cross-currency basis blows out, bid-ask spreads widen, auctions clear with tails. Volatility rises, and rising volatility forces more margin, which forces more selling, which raises volatility again. Once that reflex starts, the system's final stage isn't chosen by ideology, it's chosen by arithmetic. Either the currency is sacrificed to reliquify the system, or asset prices are sacrificed through liquidation to restore solvency, or the authorities attempt both in sequence, trying to thread the needle. The outcome always looks sudden, but it is the inevitable consequence of the earlier stretch. To prove this is a mechanism and not a mood, you have to watch it in history where the names and costumes change, but the stages stay the same. Let's start with a case study that is so famous people think they understand it, yet most still miss the structural lesson. Germany from the end of World War I through the early 1920s. The foundation was shattered by design. Versailles imposed massive reparations, but more important than the politics was the payment structure. Obligations denominated in foreign currency and gold-linked terms, with a domestic economy damaged, an export base constrained, and a government that needed social stability and industrial reconstruction. The anchor was not the mark's credibility. The anchor was the international settlement requirement. Germany's state had a bill to pay in a unit it could not print. That is the oldest trap in finance, a mismatch between the currency of liabilities and the currency of cash flows. Then came expansion, and it did not begin as madness. It began as survival. To meet domestic obligations, wages, pensions, rebuilding, Berlin relied increasingly on the printing press and domestic credit creation. The mark supply expanded, but the system pretended the real constraint was political will. It wasn't. The constraint was external settlement. As the mark weakened, the cost of acquiring foreign currency to meet reparations rose, which forced more printing, which weakened the mark further. That is the loss of control phase, a feedback loop where the response to the problem accelerates the problem. Domestic prices rise, but the more important detail is the FX channel. Inflation is not just too much money. It is, mechanically, a currency being repriced lower against what it must buy. When the obligations are external, the repricing becomes self-reinforcing. And then the inevitable outcome arrived, not as a sudden moral collapse, but as a mechanical resolution, a currency reset. The hyperinflation was not a random explosion. It was the system choosing to default in real terms rather than default in nominal terms. The obligations did not vanish. People's savings vanished. The domestic bond market became a graveyard of paper promises. Wage contracts had to be rewritten constantly. The state regained breathing room only when the currency regime changed, when the Rentenmark and later the Reichsmark re-anchored credibility, alongside external support and restructuring. The lesson for modern viewers isn't printing is bad as a slogan. The lesson is that once the foundation is mismatched to the liabilities, expansion becomes a trap, and crisis becomes a feedback loop, and the outcome becomes a forced regime change. You can call it a devaluation. You can call it a reset. You can call it a new anchor. The name doesn't matter. The mechanism does. Now, take a second case study that sits at the heart of the modern dollar era, the United States from the late 1960s through the 1970s, beginning with Bretton Woods and ending with the inflationary and FX turbulence of the decade. The foundation here was the post-war dollar-gold architecture. The dollar was the settlement asset for global trade, and foreign official holders could convert dollars into gold at a fixed price. That convertibility was the credibility anchor. It was the promise that the world's reserve currency had an external constraint. Under that foundation, global trade and finance could expand because the settlement unit was trusted. Then came expansion, and again it looked like prosperity. The U.S. ran fiscal deficits for war and domestic programs. Dollars flowed abroad through trade deficits and capital outflows. Foreign central banks accumulated dollars. Eurodollar markets grew. Dollar liabilities created outside U.S. borders, beyond direct U.S. reserve constraints, effectively an early shadow banking layer. The world's demand for dollars was enormous, but the supply of dollar claims grew faster than the gold stock backing the promise of convertibility. This is where the debasement stage becomes visible in the balance sheet arithmetic. More claims than the foundation can honor if everyone asks at once. The system works as long as confidence remains that redemption won't be demanded simultaneously. That is how every maturity transformation scheme survives, by relying on synchronized belief. Crisis arrives when the belief becomes rationally questionable. By the late 1960s and early 1970s, foreign holders had reason to doubt that U.S. gold could cover the outstanding external dollar claims. Conversion requests accelerated. Gold outflows pressured the U.S. position. The feedback loop tightened. Maintaining convertibility would require tighter policy, higher rates, and reduced dollar outflows, but tighter policy threatened domestic growth and political priorities. The system lost control because the policy objective conflicted with the external promise. And then the inevitable outcome came, not because anyone was clever, but because the arithmetic forced it. In August 1971, the U.S. effectively ended gold convertibility for foreign official holders, the Nixon shock. That was the regime change. The foundation was removed. The dollar became a fiat settlement asset, supported by policy credibility rather than an explicit redemption constraint. What followed in the 1970s is often remembered as stagflation, but look at it structurally. Once the anchor was severed, the system had to find a new equilibrium price for the dollar and a new equilibrium for inflation expectations. The dollar weakened at points. Oil shocks interacted with currency dynamics. Inflation transmitted through imports and commodity pricing. Bond yields rose as markets demanded compensation for inflation risk and policy uncertainty. Volatility increased because the regime changed and participants had to relearn what the unit of account meant. That decade is a living demonstration of the mechanism. Foundation anchored, expansion beyond anchor, crisis when redemption credibility fails, inevitable outcome as a new regime, with inflation and yields repriced to reflect reality. Now connect these two case studies to what you see today without even fully applying it yet. In Weimar, the stress was external settlement in foreign currency terms, the feedback loop was FX-driven inflation, and the resolution was a currency reset. In Bretton Woods, the stress was external redemption credibility, the feedback loop was gold outflows and policy conflict, and the resolution was an explicit regime change with inflationary repricing. Different eras, different institutions, same mechanism. And now the modern system has evolved the most sophisticated version of the same pattern, a reserve currency that is not redeemable into gold, but is redeemable into liquidity, into the ability to settle funding obligations, roll debt, and meet margin calls. That's the new convertibility. Not gold, liquidity. This is where shadow banking stops being a niche topic and becomes the central node. Shadow banking is where the system manufactures liquidity claims against collateral while avoiding the optics and constraints of traditional banks. It is where duration hides behind daily funding. It is where leverage hides behind netting and rehypothecation. It is where cash-like instruments are created, money market shares, stable value funds, repo-funded holdings that behave like deposits until they don't. And because the modern world runs on the dollar as the settlement asset, the entire shadow structure is, in effect, a massive network of dollar promises that must be rolled continuously. So when you hear shadow bank collapse, the right question is not which institutions are in trouble. The right question is, where's the dollar settlement chain breaking? Because the dollar system is not only US banks, it is global. The euro-dollar complex, offshore dollar funding, FX swaps that synthetically borrow dollars against foreign currencies, and cross-currency basis trades that reveal stress when the price of swapping into dollars rises. These are the pressure gauges. The crisis stage in the modern pattern doesn't announce itself with a single bank run on a retail branch. It announces itself with small mechanical failures, widening haircuts, collateral disputes, rising fails to deliver, sudden spikes in repo rates, higher swap spreads, higher implied vol, and bond auctions that clear weekly. The headlines lag because the truth is too technical to trend until it's too late. And here's where it gets even more boring but terrifying. The bridge between inflation and deflation in this system is liquidity itself. Inflation can surge when the currency weakens and commodity prices rise, or when policy attempts to re-liquefy the system by expanding balance sheets. Deflation can strike when funding tightens, and leverage is forced to unwind, collapsing asset prices and shrinking credit. The machine can alternate between them in short windows. That's why people get whiplash. One month they fear inflation, the next they fear recession, and both are correct depending on which layer of the system you're measuring. The shadow layer is the translator between these regimes because it amplifies both. When it expands, it suppresses volatility and fuels asset inflation. When it contracts, it spikes volatility and forces liquidation, deflationary pressure in risk assets and credit, even as the currency channel can remain inflationary if confidence in the unit is questioned. Now bring precious metals into this, not as a romantic hedge, but as a mechanical valve. Gold and silver are not just stores of value. They are alternative settlement assets in the human imagination, and that imagination becomes real when the credibility of paper settlement wobbles. In every regime transition, the paper claims multiply first, and then at the margin, a subset of actors begins to demand settlement in something that cannot be printed. In the modern era, you see this in the difference between paper metals and physical metals, paper gold and paper silver. Futures contracts, unallocated accounts, ETFs, can expand almost infinitely because they are balance sheet promises, nettable claims. Physical metal cannot. It has to be mined, refined, delivered, and stored. That's why in stress, the tell isn't always the headline spot price. The tell is the premium, the delivery terms, the inventory drawdowns, and the tightness in specific forms. Bars, coins, kilobars, 1,000-ounce silver bars, where the physical supply chain meets the financial demand. When funding markets seize, leverage players sell what they can, not what they want. That can hit paper metal prices hard in the moment because futures positions are liquid and margin-driven. But simultaneously, if confidence in the settlement regime is cracking, physical demand can rise, premiums can widen, and inventory can draw down. That divergence, paper price volatility versus physical tightness, is a fingerprint of transition stress. It's the same mechanism wearing a modern outfit. Claims expand far beyond deliverable supply, then crisis forces a confrontation with reality, and the outcome is a repricing of what settlement means. So the hook is not that something is off. The hook is that the sequence is visible, stage by stage, if you know where to look. A credible foundation, the dollar as global settlement, supported by deep treasury markets and a central bank backstop, enabled an explosion of global credit and collateralized promises. Expansion, the multiplication of dollar claims through shadow structures, offshore funding, and maturity transformation, looked like stability because it compressed spreads and dampened volatility. Crisis begins when the feedback loop flips. Funding costs rise, collateral becomes scarce, and volatility forces margin calls that force selling, which forces more volatility. The inevitable outcome arrives when the system must choose how to restore settlement, either sacrifice the currency's purchasing power through reflationary policy, or sacrifice asset prices through liquidation, or attempt the most fragile path, tighten into fragility until something breaks, then ease into inflation, oscillating between the two. That brings you to the threshold we're standing on. If you want to understand why the shadow banking layer is the first crack you're allowed to see, it's because it is the least politically defensible part of the machine. Retail banks have voters. Sovereign debt has ideology. Shadow plumbing has none. It will be blamed, scapegoated, quietly merged, quietly backstopped, and quietly relabeled. But the crack isn't the story. The story is the dollar machine behind it, and the fact that every historical regime change begins with stress in the settlement layer. And that is the bridging thought you cannot ignore. Once the settlement layer starts to fracture, the next question is never, will volatility rise? It's, where does the stress go next? Into FX, into bond yields, into funding markets, or into the only assets that sit outside the promise network? Bond yields, FX stress, and why gold and silver become the exit door. So if the stress can't hide forever, where does it go next? Into the channels that actually settle the system: currencies, sovereign funding, and collateralized dollar credit. And before we apply the mechanism to the present, you need one more proof point, one more moment in history where a contained crack turned into a full system repricing, because the settlement layer, not the headlines, was what failed. Look at the United Kingdom in 1976, not as folklore but as mechanics. The foundation was post-war credibility. Sterling still carried the memory of empire, London still mattered, and the state assumed it could finance itself because it always had. That foundation wasn't gold, it wasn't a peg, it was status, confidence that sterling-denominated promises would be honored without destroying the currency. Then came expansion. The UK ran persistent current account pressures, fiscal strains, and a policy bias toward maintaining employment and social spending. Inflation was elevated through the 1970s, and the state leaned on borrowing in a world where investors were starting to demand compensation for inflation risk. The more inflation rose, the more yields had to rise to attract funding, and the higher yields went, the more fragile the debt dynamics became. That is the expansion stage. Promises grow faster than the system's real capacity to fund them at stable prices. Then the crisis phase arrived through FX. Sterling weakened sharply in 1976, and each leg down didn't merely hurt pride. It mechanically increased inflation transmission through imports and energy, raised the expected path of inflation, and forced investors to demand even higher yields. The feedback loop tightened because the government needed funding, and markets demanded a higher price for providing it. That's where loss of control shows up. Not a single dramatic default, but a sliding currency that forces rising yields, that forces policy stress. The Bank of England could provide liquidity, but liquidity without credibility becomes fuel for further currency weakness. The UK was pushed into an IMF program in late 1976, and the conditions were not symbolic. They were an admission that the system required external credibility to stop the loop. The inevitable outcome was not the end of Britain. It was a regime adjustment, fiscal restraint and policy tightening to restore confidence in the settlement unit, sterling. Because without that, every promise denominated in it would be repriced lower in real terms. That is the mechanism again. Foundation, expansion, crisis via settlement stress, and outcome via regime change to restore credibility. Now take that proof and look at today's system with adult eyes. The foundation is the dollar itself, the global settlement asset, the dominant invoicing currency for trade, the collateral base for global funding, and the core of risk-free pricing through the US Treasury curve. The reason this foundation has been so powerful is not mysticism, it is depth. The Treasury market is the reference instrument for everything: discount rates, hedges, repo collateral, and the base layer that allows leverage to exist at scale. The world is long dollars structurally because global liabilities are dollar-linked, even when the borrower isn't American. And the modern convertibility promise is that in stress, you can obtain dollars to settle, either through markets or through swap lines or through policy intervention. That's the foundation. Check. Then comes expansion. Dollar claims have multiplied far beyond domestic deposits and loans. Shadow banking turned treasuries and credit products into collateral for chains of borrowing, repo funding, prime brokerage leverage, and derivatives exposures that are fine until volatility changes the margin math. Offshore dollar funding grows through FX swaps. Institutions that hold euros, yen, or other currencies can synthetically borrow dollars by swapping their local currency into dollars for a term. That is a hidden debt rollover schedule. Each maturity is a refinancing event, and each refinancing event is priced by the scarcity of dollars at that moment. The euro-dollar ecosystem isn't a metaphor. It's a machine that creates dollar liabilities without a single retail depositor ever walking into a branch. Verified. Expansion also shows up in asset composition. The system has been encouraged, by regulation, by risk models, by yield hunger, to hold long-duration assets financed with short-duration liabilities. That is the oldest trade in history. Borrow short, buy long, pocket the spread. It works until rates rise or funding tightens. In the last decade, duration became the quiet leverage no one called leverage. When yields were pinned and volatility suppressed, everybody looked solvent. As soon as yields rise, the mark-to-market losses are real, collateral values shift, and the need for funding increases at the worst possible moment. That's why shadow fragility is not about bad actors. It's about maturity mismatch sitting on top of collateral values that can move violently. Undeniable. Now crisis. It begins at the margins. Literally, margins. When volatility rises, risk managers raise haircuts. When haircuts rise, you need more collateral to borrow the same dollars. When you need more collateral, you sell assets to raise cash, or free up high-quality collateral. That selling pushes prices down and yields up, which increases volatility, which triggers more margin calls. This is not psychology. This is the mechanical reflex of the system. Check. You can see it in the Treasury market itself. Auctions and funding conditions become stress transmitters. Watch bid-to-cover ratios, not as a trivia statistic, but as a signal of marginal demand. Weak bid-to-cover means the market is demanding more yield to absorb supply. Watch tails. When an auction clears at a higher yield than expected, it's telling you investors require a concession to take duration. Watch the term premium. When term premium rises, investors are demanding extra compensation for holding long bonds because they distrust inflation outcomes or policy credibility. And watch real yields, because rising real yields are a direct tightening of financial conditions, pulling down risk assets and increasing the debt service burden in real terms. Verified. Debt rollovers are the next amplifier. In a high-debt system, maturity schedules matter more than ideologies. When a sovereign has to refinance large amounts of debt, rising yields are not abstract. They are a mechanical increase in interest expense. If deficits persist, issuance persists. If issuance persists into a market demanding higher term premium, yields rise further. Then the system hits the point where private balance sheets cannot or will not absorb the duration without leverage, and leverage depends on repo. That's where funding markets stop being background noise and become the story. Undeniable. Now layer in swap spreads. Swap spreads reflect the relationship between Treasury yields and interest rate swap rates. Among other things, they reflect balance sheet costs, hedging demand, and stress in dealer intermediation. When swap spreads move sharply, it can signal that dealers are stepping back, that hedging is becoming expensive, or that the plumbing is clogged. Combined with repo stress, it can mean the system is having trouble distributing collateral and risk. Add in the basis trade, highly leveraged strategies that exploit small differences between Treasury cash bonds and futures prices. When funding is cheap and stable, basis trade leverage can be enormous. When repo rates rise or haircuts widen, the basis trade becomes forced selling of treasuries. That creates a paradox. The risk-free asset becomes a volatility source because of leverage built on top of it. Check. Now take FX and global currency stress, the other settlement channel. When U.S. rates rise relative to other countries, the dollar tends to strengthen because capital chases yield and safety. A stronger dollar is a tightening force for the world because so much global trade and debt is dollar-linked. Emerging markets feel it first. Local currencies weaken, import costs rise, inflation transmits, central banks tighten to defend currencies, growth slows, and debt service in dollars becomes harder. Even developed markets feel it through the cross-currency basis. The price of swapping into dollars can become punitive, signaling dollar funding stress. That stress shows up as widening basis, higher hedging costs, and pressure on foreign institutions that need dollars. Verified. Now inflation-deflation dynamics. In this mechanism, inflation and deflation are not contradictory. They are sequential expressions of the same stress. Dollar strength can be deflationary for risk assets and global growth because it tightens conditions and forces deleveraging. But currency weakness, if confidence in the unit wobbles, transmits inflation through imports and commodities, the system can swing, tightening triggers, deflationary liquidation, then authorities respond to stabilize funding markets, which risks reflation and currency debasement. The public debates which one is real. The market lives both, depending on the time frame and the segment. Undeniable. Now the liquidity squeeze. This is where shadow banking collapses in practice. It rarely collapses as a single event. It collapses as a sequence of roll failures and collateral disputes. Repo lenders demand higher haircuts. Prime brokers reduce leverage. Money market funds get cautious. Commercial paper markets thin out. Funding tenors shorten. Risk managers mark down collateral. Suddenly, the same portfolio that looked safe on a spreadsheet becomes unfinanceable at scale. That's when volatility spikes, not because people panic, but because the system is forced to sell what can be sold. The most liquid assets get dumped first. That includes treasuries, equities, and yes, paper gold and paper silver. Anything with a tight bid-ask and immediate settlement. Check. Risk asset volatility is not an emotional event. It's a funding event. When implied volatility rises, option hedging flows accelerate. Dealers who are short gamma hedge by selling into down moves and buying into up moves, amplifying swings. Systematic strategies de-risk as vol targets are breached. Credit spreads widen, which raises borrowing costs, which tightens conditions further. Equity drawdowns reduce collateral values, which tightens margin again. The machine reinforces itself. Verified. Now, precious metals as stress valves. This is where most commentary gets sloppy. Gold and silver don't move because people are scared. They move because settlement credibility is being repriced, and because positioning and margin mechanics create violent swings. In the early phase of a liquidity crunch, paper metals can get hit. Futures positions are margined, and when margin requirements rise, leverage long sell to raise cash. That can push spot prices down sharply, even as the fundamental demand for physical metal is rising. This is why you must separate paper price action from physical market conditions. Undeniable. In the physical market, stress shows up differently. Delivery delays, rising premiums, inventory drawdowns, and tightness in specific bar formats. Gold is dense value. Small volume moves a lot of dollars. Silver is bulky value. Physical constraints bite faster because moving and storing it is harder. And industrial demand competes with investment demand. When the system starts doubting paper settlement, some holders prefer allocated metal or take delivery, reducing available floating supply. If inventories at key warehouses draw down, the market becomes sensitive to any incremental demand. Premiums widen because physical is a supply chain, not a spreadsheet. Refining capacity, fabrication, and transport become limiting factors. In that environment, spot can be one thing, while real-world acquisition cost is another. That divergence is the signal. Check. Silver has an extra layer. It's both monetary and industrial. In expansions, industrial demand provides a baseline and investment demand comes and goes with sentiment. In stress regimes, investment demand can surge precisely when supply is least flexible. Mines cannot ramp quickly. Recycling responds with lag. If inventories have already been drawn down during prior cycles, there is less buffer. The result is that silver can exhibit brutal whipsaws. Liquidation-driven drops in paper price followed by sharp squeezes when physical tightness collides with renewed demand. Gold tends to be steadier, but when real yields swing and the dollar moves violently, gold also swings, especially if funds use it as a liquidity source temporarily. The key is that both metals become the pressure release when trust in paper claims erodes, even if the release is not a straight lineup. Verified. Now put the whole present-day application in order, step by step as the mechanism demands. The foundation is the dollar settlement system anchored by treasuries and the promise of liquidity provision. Check. Expansion is the multiplication of dollar claims through shadow leverage, offshore funding via FX swaps, and duration financed short. Verified. Crisis begins when yields rise and volatility increases, forcing margin, widening haircuts, and straining repo and dealer balance sheets. Undeniable. The inevitable outcome is that something must give. Either policy must suppress yields and reliquefy the machine, risking currency debasement and renewed inflation transmission, or markets must clear through liquidation, risking deflationary collapse in risk assets and credit. The system will likely attempt both at different times, because the political and financial incentives conflict, but the arithmetic doesn't. Check. And you can measure where you are in real time. Watch Treasury auctions, bid to cover, tails, and indirect bidder participation for signs of marginal demand and foreign appetite. Watch term premium and real yields for whether the market is demanding additional compensation for duration. Watch swap spreads for dealer balance sheet stress and hedging dysfunction. Watch repo rates, fails, and collateral specialness, because when high-quality collateral becomes scarce or financing becomes expensive, leverage unwinds. Watch cross-currency basis for global dollar funding stress, because when it costs more to swap into dollars, the world is short dollars again. Watch volatility, because volatility is the tax on leverage. And watch the physical metals market, premiums, delivery conditions, and inventory drawdowns, because those are the places paper promises collide with finite supply. Verified. Now the final warning, stated cleanly. This time is not different. American exceptionalism is not a risk management tool. Tech will save us is not a funding mechanism. Modern optimism is not collateral. They are stories people tell when the math is uncomfortable. The machine does not care about stories. It cares about rollovers, yields, and settlement. Undeniable. So what do you do with this practically without becoming the liquidity exit for someone else's leverage? First, stop watching only prices and start watching plumbing. If auctions weaken and term premium rises, duration is being repriced. If repo funding tightens and haircuts widen, leverage is being forced out. If cross-currency basis widens, global dollar stress is rising. If real yields rise sharply, risk assets are being squeezed. If volatility climbs and stays elevated, margin mechanics will amplify moves. And if paper metal prices detach from physical premiums and inventories draw down, you're seeing the stress valve activate even if the screen lies. Check. Second, think in scenarios, not narratives. In one path, policymakers lean toward liquidity support, suppressing yields and stabilizing funding. which can weaken the dollar over time and reignite inflation transmission, supportive for gold and potentially explosive for silver if physical tightness emerges. In another path, policy stays tight into fragility. Liquidity breaks, risk assets and credit deflate, and paper metals can get sold for cash before the deeper monetary demand reasserts itself. Your job is not to predict the headline. Your job is to recognize the stage of the mechanism and avoid being positioned in the most fragile part of the chain when the roll fails. Verified. Undeniable. The verdict is simple. When settlement stress rises, the system does not recover by wishing, it resets by pricing. The only question that matters is whether you're positioned as an observer of that repricing or as the collateral that gets sold to pay for it. So which one are you going to be?